Imagine waking up tomorrow morning and hearing a shocking announcement. Your bank is closed. Not for a few hours, not for maintenance, indefinitely. You grab your phone and try to log in. Error. You drive to the nearest branch. A crowd has already formed outside. People are yelling. Some are crying. Everyone wants the same thing: their money. The money they spent years saving. The money they believed was safe. But suddenly, nobody can access it. This sounds like something from a movie, but it has happened before. In 1929, millions of people believed their banks were secure. Then, the financial system began to crack. Bank failure spread across the country. Families lost access to savings. Businesses collapsed. Entire life savings vanished almost overnight. The terrifying part wasn't that people were poor. The terrifying part was that many still had money on paper. They just couldn't reach it. And that's why one question matters more than ever. If banks fail, where should you keep your cash? History already gave us the answer. And the lessons from 1929 are far more important today than most people realize. Let's begin. To understand where cash should be stored during a banking crisis, we first need to understand what happened in 1929. When the stock market crashed, fear spread rapidly. People rushed to banks. They wanted to withdraw their money before everyone else. But banks operate on a simple principle. They don't keep everyone's cash sitting inside vaults. Most deposits are loaned out. When thousands of customers demand money at the same time, banks can't meet those withdrawals. This creates what economists call a bank run. One person gets scared, then 10, then 100, then thousands. Eventually, the bank runs out of cash. Doors close, depositors panic, and confidence disappears. Between 1930 and 1933, thousands of banks failed across America.
Millions of people lost access to savings. Some recovered part of their money years later. Many never did. The lesson was brutal. Money inside a bank is only useful if you can actually access it. Now, here's where most people make a mistake. They hear stories about bank failures and immediately think, I'll just keep everything at home. That sounds logical. But history shows that's dangerous too. Imagine keeping $10,000 under your mattress. What happens if there's a fire, a flood, a burglary, a natural disaster? Cash stored entirely at home creates a different kind of risk. In every major crisis, people who relied on a single storage location often suffered the most. The key lesson isn't to move all your money out of banks. The key lesson is diversification. The same principle investors use for stocks applies to cash. Never depend on a single point of failure. The first place to store cash is still a bank. That might sound surprising. But remember, today's financial system is very different from 1929. Modern banking regulations were created specifically because of the Great Depression. Deposit insurance exists to protect customers. The goal isn't to avoid banks completely. The goal is to avoid concentrating all your money in one place. Think of a bank as your primary storage location, not your only storage location. If one institution experiences problems, you still have alternatives. History rewards preparation, not panic. The second place is physical emergency cash. Not huge amounts, not your life savings, just enough to handle short-term disruptions. Imagine a power outage, an internet outage, a payment network failure. ATMs stop working, card payments fail. In those situations, physical cash becomes valuable. During crises, people often discover that digital numbers on a screen aren't always immediately accessible. Having a small emergency reserve provides flexibility. It's not about expecting the collapse of civilization. It's about preparing for temporary disruptions. The people who stay calm during emergencies are usually the people who prepared beforehand. The third lesson from history is geographic diversification. Many people keep all their money tied to one bank branch, one city,
Or one financial institution. That creates concentration risk.
During financial panics, local problems can spread quickly. Diversification reduces vulnerability. Think of it like building multiple exits into a building. If one door becomes blocked, another remains available. Financial resilience works the same way. But there is another lesson from 1929 that almost nobody talks about. The biggest threat wasn't always bank failure. It was purchasing power loss. Some people successfully withdrew their cash. They felt relieved.